Hello and welcome to SharesCart. My name is Satakshi Pandey and today we will discuss IndusInd General Insurance, India's non-life insurance sector, which has many companies, amongst which one of them that's been quietly undergoing a significant transformation, which is IndusInd General Insurance, formerly known as Reliance General Insurance. The company was established in 2000 under the Reliance Capital umbrella following the acquisition of Reliance Capital by IndusInd International Holdings or IHL. The company was rebranded. It's now headquartered in Mumbai, operates through 127 offices, has over 90,000 intermediaries and serves individuals, SMEs and corporates across motor, health, travel, fire, marine and crop insurance. Looking at the financials, the numbers from FY 2023 to FY 25 revenue has grown from roughly 7,457 CR to 8,589 CR, about 8.5% growth in the last year. Net profit has also improved, with PAT growing over 12% in FY 25 to 315 CR. Gross written premiums stood at 12,667 CR in FY 25, growing at about 7%. However, there are two metrics that deserve attention. The combined ratio, which measures underwriting profitability, has risen from 110% in FY 2023 to 116.63% in FY 25. A ratio above 100% means the company is paying out more on claims and expenses that it earns in premiums. For every rupee of premium, it's spending about 1.17. That is offset by investment income, so the company is still profitable overall, but the core underwriting business is not yet self-sustaining. The solvency ratio, the regulator's measure of financial health, sits at 1.59 times. IRDAI requires a minimum of 1.5 times, so the company is compliant, but the buffer is thin. Now, talking about the valuation, the company is currently unlisted with a reported market cap of around 15,381 CR and a share price of rupees 575. Its market cap to gross written premium ratio is 1.21 times, significantly cheaper than ICICI Lombard at 3.14 times and SBI General at around twice the time. The analysis uses this MCap GWP multiple to build three scenarios for FY 30. In the base case, assuming 10% GWP growth, re-rating of the multiple, the implied price per share by FY 30 is around 2005, a 5-year CAGR of roughly 28%. These projections, however, depend on three things happening: the combined ratio improving meaningfully, GWP sustaining at 10% CAGR, and the company eventually listing via an IPO. Now, peer comparison against ICICI Lombard and SBI General, IndusInd GI is the cheapest on valuation, but the discount reflects real concerns. Its combined ratio of 116.63% compares unfavorably to ICICI Lombard's 102.8% and SBI General's 111.2%. ICICI Lombard's PAT is 2,505 CR versus IndusInd's rupees 315 CR on the comparable revenue basis, a significant gap in operational efficiency. The broader picture: India's non-life insurance penetration is just 0.9% of the GDP, one of the lowest globally, which means the structural growth opportunity is real. The non-life premiums are expected to grow at a 10% CAGR through 2030, supported by government reforms including 100% FDI, liberalization and simplified product approval processes. For IndusInd General Insurance specifically, the IIHL acquisition removes legacy baggage from the Reliance Capital era and potentially unlocks access to IndusInd's bank branch network. For bancassurance distribution, 100 crore capital infusion from the Hinduja Group is early 2025 adds to the credibility of promoter support. Summary is that this is a company at an inflection point. The valuation gap relative to peers is wide and real, but so are the operational challenges. Particularly the rising combined ratio and thin solvency buffer. The investment case is essentially a turnaround story. If the new management can improve underwriting discipline, leverage the bank, distribute network and sustain premium growth, the re-rating potential is significant. If those conditions don't materialize, the discount is where it deserves to be. Thank you for watching SharesCart.